Hi everyone, my name is Frank Amadeo. I'm the brand manager here at Paragon Solutions, and I will be your webinar host for today. I want to personally thank you all for joining us for today's webinar titled 10 Common Pitfalls in Quote-to-Cash Business Processes for Life Sciences. Before we get started, I'd like to go over a few housekeeping details. When you initially logged in, a control panel appeared, usually on the right of your screen. This control panel can be closed and opened at any time during the webinar by clicking the red arrow button found towards the top left of the panel. Use the question panel to submit questions anytime during the webinar. We will hold all questions until the end. If time does not allow us to answer every question, we will respond to you directly. The webinar will be recorded, and a link to video and the presentation slides will be emailed to you within 48 hours. You will also be able to find it on our website listed here. Finally, there will be a short survey at the end of the webinar that takes approximately 2 to 3 minutes to complete. If you have the time, we would appreciate your feedback so we can continually provide value and ensure that the topics are relevant to you. I'd like to provide a brief introduction to Paragon Solutions and today's speaker. Paragon is a professional services firm providing a full spectrum of consulting services from advisory through solution, design, and implementation for tighter alignment between business and IT. We focus on building solutions that address our clients' specific needs. We are headquartered in Cranford, New Jersey, and have offices throughout the U.S. and Europe. Paragon has been in business for over 30 years, building industry and domain experience in the life sciences, financial services, communications, healthcare, and insurance industries. If you'd like to follow Paragon Solutions on Twitter, you can do so at ConsultParagon. Also, if you'd like to tweet your questions, comments, or participate in the online discussion as we live tweet during the webinar, you can do so by using the hashtag ParagonLive. At this point, I'd like to introduce our expert for today, Leanne Sino. Leanne is a senior consultant with Paragon Solutions, working under the life sciences vertical focused on revenue management. She has recently supported a large software implementation in both testing, data validation, and downstream system remediation capacities, as well as building out risks and opportunities surrounding financial and operational business processes, reporting, and analytics. She has proven herself a thought leader and innovator on the topic of gross-to-net revenue management throughout her tenure at various Tier 1 pharma companies.
Thank you, Frank. Hello, everyone. I'd like to start off by giving a quick overview to the quote-to-cash concept and review a few reasons as to why end-to-end business process definition is so crucial on the matter. Why define these end-to-end business processes as they relate to your quote-to-cash business? Firstly, mapping your quote-to-cash business processes end-to-end will help you initially acknowledge the cross-functional organization as it relates. This acknowledgement is the first step of what many of us know as breaking down the silos. As we know, a successfully cross-functional organization is much more efficient and typically more compliant than that of a siloed one. Once end-to-end processes are defined or even mapped out, it is now that much easier to audit or even implement new documentation, internal control, workflows, and other audit and compliance-related items. Furthermore, having existing, clearly defined end-to-end business processes makes life a lot easier come time for system testing, as they will prove the foundation for building test cases. Those last-minute end-to-end test cases that are pieced together and not necessarily by the appropriate business stakeholders tend to lead to untested scenarios, missed upstream or downstream processes and systems, and even unrealized financial outcomes. And lastly, it is found that better business outcomes are achieved when stakeholders across the organization are invested in the complete end-to-end business process. Without true definition and awareness of these processes, investment by the business stakeholders cannot be possible. Throughout today's discussion, we will be referring to incidents or pitfalls as they occur within varying phases of the quote-to-cash process. To briefly explain these phases, we start with the quote phase, also referred to as the contract phase. This phase speaks largely to sales and the account team, as well as sales and marketing and contracting business processes, such as pricing analytics, customer contract or amendment creation, review, negotiation, and implementation, as well as any pre-deal analytics. The revenue recognition phase is usually comprised largely of operations and financial reporting activities. This phase is also commonly referred to as the gross to net phase. This is the phase between the gross sale of the product to the net sales realization and reporting of that product. This phase is heavy in payment processing and financial postings. Therefore, system and data architecture is typically leveraged heavily. Post-deal analytics typically occur mostly within this phase, bleeding out a bit into the cash phase for some organizations. The final phase, the cash phase, focuses primarily on customer deductions, accounts receivable aging, and cash posting business processes, as well as inputs for cash forecasting, DSO calculations, etc. Before we jump right in, let's quickly review a few common misconceptions of quote-to-cash. For a deeper look into this topic, please visit my latest Paragon blog post, the 3 shared misconceptions of quote-to-cash, or gross to net. The first misconception is that quote-to-cash review, assessment, optimization, whatever it is, should be approached process by process, piece by piece, versus looking at the complete end-to-end process holistically. This approach is what we like to call breaking down the silos, silo by silo. It's typically a segmented approach to an already segmented process, as well as a typically segmented organization. The risk that is associated is more chances to miss processes, integration points, downstream implications, etc. Another huge misconception, which we hear about quite a bit in revenue management-related conferences and seminars, is that the majority of issues and associated risk exist within the revenue recognition phase, also known as the gross to net phase. This goes hand in hand with the next misconception, that the most important tasks occur within the finance organization or the gross to net organization. While the majority of quote-to-cash issues may be detected during a business process within the gross to net phase, this does not typically mean that the problem lies within the phase itself. Usually, what we see at the time of revenue recognition is a product of an upstream quote or contract-related business process. Finance usually just gets the bad rap, despite the facts regarding where the issue truly originated from. This also frequently causes too much time, effort, and money to be spent in areas of the process and organization to correct issues and optimize when the wrong area or phase in the process is actually being put under the microscope. A misconception commonly made not only by practitioners of these processes themselves, but other business partners and even vendors, is that optimization of these business processes can be achieved solely through automation. My recent blog helps take this apart in further detail. Finally, the ultimate misconception is that your gross to net forecast, which is based so largely from the outcomes of your quote-to-cash business processes, must be heavy estimates loaded with hefty assumptions. With an optimally performing quote-to-cash business, more accurate, secured, and timely inputs can be integrated into your forecast, changing many of those variables to fixed values. First, we'll start with the quote-to-contract phase. Our first 3 pitfalls for discussion exist within business processes of the quote phase, focusing more so on the operations within the sales and marketing or contracting functions within the organization. This is also commonly referred to as pre-deal analytics. In our first pitfall, we find that the actual paper contract or amendment itself is only truly reviewed by one person or several personnel, but within one department. Without a thorough and qualified review of each and every contracting document that flows through your organization, contracting terms are sure to be missed, discounts and incentives may be misinterpreted. What this translates into further downstream is inaccuracies or missed changes in accruals or forecasted discounts. Then, it is not typically until actuals are received against that new contract that the discrepancy is found in the form of a favorability or unfavorability in your financial statements. If these discrepancies are found too late, after a financial period is closed, you may run the risk of having reported your net sales inaccurately or taking larger than expected or unreserved for hits to your balance sheet once actual payments are processed. Our second pitfall, as mentioned, regards pre-deal analytics as well. Here, we see a siloed approach within the business process itself. When a new customer contract or amendment is introduced for analysis, the full customer and product profit and loss statement, or P&L, is not taken into consideration at the time of review. The full picture for that customer and product, and even a given channel, is not looked at and taken into consideration, but rather given an isolated change. A good part of the time, new or even existing discounts and incentives are overlooked during the process because of this lack of thorough review. In effect, a gross or net price could be offered to a customer that is too low, usually without even knowing it. Profitability therefore begins to erode for that channel and product, and usually goes for some time before it's found out why. Besides the issues of profitability and margin, any and all required financial actions that are now reactive versus proactive in regards to adjusted accruals, forecasted sales, reserve balances, etc. If the full implication of the new contract terms are not realized and taken into consideration upstream, well, of course, how would these changes ever be accounted for downstream, especially on the financial end of things? Let's keep on the topic of not reviewing and considering the whole picture during the contract phase as we discuss this third pitfall. Here, a similar outcome of the pitfall is achieved, that of a price given too low. Profitability begins to erode while going unnoticed for some period of time. But this time, it is less about reviewing the contract terms more carefully or the channel gross to net itself, but the volumes in the sales channels themselves, coupled with customer behavior. The question now becomes, are you taking into consideration volumes associated with these contract terms and sales channels and how they may affect the bottom line of the deal? Is there a fair amount of awareness as to how a change in customer behavior, whether it be buying or selling patterns, may affect your eventual net price? Are you building supported assumptions of the like into your pre-deal analytics? This pitfall is typically the toughest to catch farther down the road, as it depends on a very detailed and efficient level of reporting at the contract level and sales type level. A shift in customer behavior occurs, and it's not until you've been processing actuals for quite some time against those accruals that you're finally able to pinpoint, assess, and adjust for these changes. It is even at this point later on that you may discover the terms you have extended and that are now effective are lower net than you had originally thought.